If your paycheck disappeared for 1 week, would your life stay normal? Or would everything start wobbling? That is the quiet test millions of Americans are failing. The scary part is not that people are lazy, reckless, or buying too much coffee. The scary part is that many are working, paying bills, cutting back, and still losing ground. This video breaks down 15 signs that the paycheck-to-paycheck life has become the new normal, why the famous 78% number needs context, and how to spot the warning signs before a small problem becomes a financial trap. The first sign is that one late paycheck would break the whole month. That is the cleanest way to understand the 78% idea. The strongest version of that claim comes from payroll surveys, asking workers how hard it would be to meet financial obligations if their next paycheck arrived 1 week late. In recent years, the share saying it would be somewhat or very difficult has sat in the high 70s. That does not mean every household has exactly $0. It means the timing of income has become just as important as the amount of income. Rent, car notes, utilities, insurance, phone bills, subscriptions, groceries, school costs, and debt payments all arrive with due dates. A worker can technically be employed and still be financially fragile if the calendar has no room for delay. This is why the phrase paycheck to paycheck is so powerful. It is not only about being poor, it is about having no shock absorber. A 1-week delay should be annoying. For millions, it would be a crisis. That is the first red flag. The budget only works when every dollar lands on the exact day it is expected. The uncomfortable part is that modern bills are less forgiving than modern pay. Many workers are paid every 2 weeks, while bills hit monthly, weekly, or randomly. A due date can punish someone who is not broke in total, but is broke on the wrong day. That is why timing has become a hidden tax on working people. The money may technically be coming, but the fee, penalty, or overdraft arrives first. The second sign is that rent is eating the paycheck before life even begins. Housing used to be described as a stable foundation. For many renters now, it feels like a financial vacuum. Housing researchers have found that nearly half of renter households are cost-burdened, meaning they spend more than 30% of income on rent and utilities. The number of burdened renters recently reached a record high, above 22 million households. The old advice was simple: keep housing under a third of your income. The new reality is harsher. Many workers cannot do that without moving far from jobs, schools, family support, or medical care. Some people are not overspending on luxury apartments. They are paying market rent in a market that moved faster than wages. Here is the controversial truth. When rent rises faster than pay, budgeting advice starts sounding like a lecture from another planet. You can cancel streaming, cook at home, and skip vacations, but if rent takes the biggest bite first, the rest of the budget becomes damage control. That is why people can be employed full-time and still feel one notice away from disaster. Rent also creates a trap before move-in. Application fees, deposits, first month's rent, utility setup, moving costs, and sometimes higher insurance can make relocation expensive even when the current place is unaffordable. People ask, why don't they just move? The answer is often simple. Moving requires cash, and cash is exactly what the rent crisis removed. The third sign is that groceries have become a weekly negotiation. Food inflation is not just a chart. It is the moment someone puts meat back, swaps fresh fruit for cheaper snacks, buys the smaller cart, or stretches one meal into two. Official price data has shown food costs continuing to rise even after the worst inflation spike cooled. The pain is worse because groceries are not optional. You can delay buying shoes. You cannot delay feeding children. Food insecurity data shows that more than 1 in 8 United States households experienced periods when access to enough food was limited by lack of money or resources in the most recent national reporting. Very low food security, where normal eating patterns are disrupted, affected millions of households. That should make people uncomfortable because this is not happening in a country without food. It is happening in a country with full shelves and families who still cannot comfortably pay for what is on them. A paycheck-to-paycheck household does not always look hungry. Sometimes it looks normal from the outside while dinner is built around whatever is cheapest, filling, and on sale. Another quiet sign is the shift from price to unit price. People stop asking, "Do I want this?" and start asking, "How many meals can I stretch from this?" They learn which foods keep children full, which items can survive a week, which store brand is acceptable, and which ingredients can cover breakfast, lunch, and dinner. That is skill, but it is also pressure. The fourth sign is that emergency savings are not really emergency savings. Many households have a few dollars in checking and call it a cushion because admitting there is no cushion is too stressful. The Federal Reserve's Household Survey has repeatedly asked whether adults could cover a $400 emergency with cash or something equivalent. In the latest available official data, about 63% said yes, which also means more than a third could not do it that way. That number matters because $400 is not a luxury emergency. It can be a tire, a medical copay, a broken phone, a school expense, or a surprise utility bill. The quiet problem is that many people can handle routine life only by avoiding surprises. But life does not avoid surprises. Cars break, kids get sick, hours get cut, rent renewals jump. The paycheck-to-paycheck sign is not simply having no savings. It is using the next paycheck as the emergency fund before the paycheck even arrives. People also hide this from themselves by moving money around. A little from checking to savings, then back again 2 days later. A Cash App balance, a forgotten card, a small refund, a family loan. It can feel like a system, but it is often financial scavenging. The household is not building a reserve, it is searching for loose oxygen. The fifth sign is that credit cards are becoming a second income. A credit card can be useful when paid in full, but for struggling households, it often becomes a bridge between income and reality. The groceries go on the card, the gas goes on the card, the small medical bill goes on the card. Then the minimum payment appears, and suddenly the bridge becomes another monthly bill. Household debt data from the New York Federal Reserve has shown total debt near $18.8 trillion, with credit card and auto loan stress still visible in delinquency trends. The problem is not that every cardholder is irresponsible. The problem is that revolving credit can disguise a pay gap for months. A family can look stable because the lights are on and the fridge has food, while the unpaid balance is quietly growing in the background. This is where the financial industry has an incentive people rarely talk about. A person who pays in full is safe. A person who carries a balance can become profitable. That does not make credit evil, but it means the system is not neutral. If your survival plan depends on interest-bearing debt, the paycheck has already stopped covering the real cost of your life. One reason this trap works is emotional. Credit separates the pain of buying from the pain of paying. The purchase solves today's problem immediately, while the cost shows up later in smaller pieces. That delay is useful in a true emergency, but when it becomes routine, it can turn ordinary bills into long-term debt. Groceries should not still be charging interest months after they were eaten. The sixth sign is that minimum payments feel normal. This is one of the most dangerous signs because it sounds responsible. You made the payment. You avoided the late fee. You protected your credit score. But minimum payments can keep people trapped because they are designed to be manageable today while stretching the debt into tomorrow. On a tight budget, the minimum payment is tempting because it gives short-term relief. The catch is that interest keeps working even when you are exhausted. A balance that felt like a temporary fix can become a permanent roommate in the budget. This is why people say, "I am paying every month," but the balance barely moves. They are not imagining it. When interest rates are high, a large share of the payment can go toward financing the debt instead of killing it. The sign is not just having debt. Plenty of people use debt strategically. The sign is when the minimum payment is all you can afford and the balance survives every paycheck like it has its own pulse. This is also why shame makes the problem worse. People who feel embarrassed avoid opening statements, avoid calling lenders, and avoid facing the exact numbers. Avoidance gives stress a hiding place. The balance does not need your attention to grow, it only needs time. The seventh sign is that the car is both necessary and unaffordable. In much of America, a car is not a status symbol. It is the way to get to work. It is childcare logistics. It is medical access. It is the grocery run. But the costs around driving have piled up. Loan payments, insurance premiums, repairs, tires, registration, fuel, parking, and tolls. When gasoline jumps or insurance renewals rise, it hits the budget fast. Recent inflation data showed energy and gasoline rising sharply over the year, while many households were already stretched. Auto loan delinquencies have also been a stress point in consumer credit reports. The painful part is that giving up a car can make someone poorer, not richer, if it destroys access to work. That is the trap. The advice to sell the car may make sense in a dense city with transit. It can be useless in a suburb, rural area, or service job schedule where buses do not match shift hours. A paycheck-to-paycheck life often includes a vehicle that is too expensive to keep but too necessary to lose. The repair cycle is especially cruel. Skip maintenance because money is short and the car may become more expensive later. Fix the car and the rent may be short now. Drive on bad tires, and safety becomes the hidden cost. This is how poverty charges interest without a lender. A small repair delayed today can become a bigger repair tomorrow. The eighth sign is that insurance feels like a bill for simply existing. Health insurance, car insurance, renter's insurance, home insurance, life insurance, pet insurance, phone insurance, warranty plans, protection plans, and add-ons all promise safety. Some are essential, some are optional, but together they create a strange modern burden. People pay every month to protect themselves from costs they could never afford directly. That is the clue. If a single uninsured event would wipe you out, the premium becomes less like a choice and more like a toll. Car insurance has been especially painful for many drivers because repair costs, vehicle values, weather losses, and claim costs can push premiums higher. Health costs create another pressure point. Even insured families can face deductibles, co-pays, out-of-network charges, and prescription costs. The paycheck-to-paycheck sign is when you are insured but still scared to use the service because the bill after insurance could be too much. That is not peace of mind, that is managed fear. Insurance also exposes a strange split in American life. People are told to be responsible by carrying coverage, yet many still cannot comfortably absorb the deductible. So the bill is paid every month, but the actual event remains terrifying. It is like owning an umbrella that still leaves you soaked if the storm is strong enough. The premium protects against disaster, but it does not always protect against financial panic. The ninth sign is that people are working more but feeling poorer. This is where the national conversation gets heated. Many people hear the economy is strong and wonder why their own life feels weak. Both things can be partly true because economic averages can hide household pressure. The labor market can add jobs while rent, food, insurance, and debt costs squeeze paychecks. Official wage data can show pay rising in dollar terms while inflation-adjusted earnings barely improve or even fall in a given period. Recent real earnings data showed that after accounting for prices, average hourly earnings were down slightly over the year. That is why a raise can feel fake. The paycheck is larger, but the grocery total, rent renewal, insurance premium, and gas receipt absorb it first. This is not just a math problem, it is a morale problem. When people work harder and still cannot build savings, they start questioning the deal itself. Work is supposed to create progress. For many, it only prevents collapse. This is why the argument over laziness misses the point. Many paycheck-to-paycheck households are not doing nothing. They are doing too much, working overtime, switching shifts, skipping rest, answering messages after hours, driving longer routes for cheaper housing, and accepting schedules that make family life harder. The problem is not a missing work ethic. The problem is that work no longer guarantees breathing room. The 10th sign is that small fees keep turning into big drains. Overdraft fees, late fees, convenience fees, activation fees, service fees, delivery fees, processing fees, paper statement fees, and cancellation fees are the mosquitoes of modern finance. One bite is annoying. A swarm can drain you. Credit card late fees have been large enough for regulators to challenge, and bank fees have long hit people with the least room for mistakes. The controversial part is that many fees are not random accidents. They are business models. A company may advertise a low price, then collect more through add-ons, penalties, or friction. A tired person working long hours may pay for delivery because time is gone. A person without savings may pay a late fee because the bill and paycheck missed each other by a day. A person without a printer may pay a document fee. These costs are easy to shame individually, but the pattern matters. The poorer the timing, the more expensive ordinary life becomes. That is a sign of financial fragility. Mistakes do not just cost money, they multiply. Fees also punish distraction, and distraction is easier when life is overloaded. A comfortable household can automate bills and keep a buffer. A tight household may have to choose the order of payments manually because paying everything at once would overdraft the account. That means more decisions, more chances to miss something, and more penalties for being human. The 11th sign is that subscriptions are silently crowding the budget. Subscriptions are not only entertainment anymore, they are software, storage, delivery memberships, fitness apps, meal services, learning platforms, children's games, security tools, cloud backups, and premium versions of things that used to be simple purchases. The trick is that each one feels small alone. The budget damage happens when they stack. Businesses like subscriptions because recurring revenue is more predictable than one-time purchases. Consumers like them because access feels easy, and the first price often feels harmless. But paycheck-to-paycheck households can lose track of small automatic charges because the mental energy of survival is already high. The sign is not having a subscription. The sign is not knowing how many are active, what renews this month, or which card each one is tied to. A subscription economy works best when people forget. A tight budget works best when people remember everything. Those two incentives are fighting each other. Annual renewals add another twist. A service may start as a small monthly charge, then renew at a higher rate after a promotion ends. A free trial may convert after the user forgets. A family may keep paying for a tool they no longer use because canceling takes attention they do not have. The subscription is not always expensive enough to trigger panic, but it is constant enough to weaken the budget. The 12th sign is that buy now, pay later starts replacing waiting. Splitting a purchase into smaller payments can feel smart. Sometimes it is harmless. But when it becomes the normal way to buy ordinary items, it can signal that income is not matching daily costs. The danger is not always interest. Sometimes the danger is stacking obligations across several purchases until the future paycheck is already crowded before it arrives. This form of financing can make a purchase feel cheaper because the brain sees the installment, not the full price. Retailers like that because smaller numbers reduce hesitation. Consumers like it because it preserves cash today. But the bill still exists. The paycheck-to-paycheck sign is when waiting feels impossible, and splitting payments becomes the only way to buy basics, clothes for work, school supplies, household items, or car repairs. That is not convenience. That is tomorrow's income being pulled into today because today is short. The risk is confusion. One installment plan is easy to remember. Several are not. They may hit different paychecks, different cards, and different weeks. When money is already tight, scattered small payments can behave like financial shrapnel. None of them looks deadly alone, but together they can make the next paycheck feel spent before it lands. The 13th sign is that families are cutting quality of life, not luxuries. People love to blame vacations, restaurants, designer clothes, and fancy gadgets. But many struggling households already cut the obvious extras. What disappears next is quieter. Dental visits, new glasses, fresh food, after-school activities, birthday gifts, home repairs, reliable shoes, oil changes, therapy, preventive care, and time with family. This is where the paycheck-to-paycheck label becomes too small. The issue is not only monthly bills, it is the slow shrinking of life. When money is tight long enough, people normalize postponing anything that does not scream. The roof leak waits. The tooth pain waits. The check engine light waits. The child's activity waits. The body waits. The future waits. A household can look responsible because it is not spending, but the truth may be that it is building hidden debt in health, maintenance, and stress. That is a real cost, even if it does not show up on a credit report yet. Deferred life has a bill. The dental visit becomes a root canal. The tire becomes a toe. The small leak becomes mold. The stress becomes sleep loss. The missed school activity becomes guilt. These are not dramatic choices made by careless people. They are trade-offs made by families trying to keep the biggest bills paid first. The 14th sign is that food banks, side hustles, and family help become part of the budget. There is no shame in using help. The shame belongs to an economy where help becomes routine for people who are already working. When households rely on relatives, community pantries, gig work, cash advances, selling items, or borrowing from friends to make normal bills, the official paycheck is not doing the whole job. Food insecurity data shows millions of households facing limited access to adequate food during the year, and that number does not capture every person quietly leaning on family support. Side hustles can be empowering when they build opportunity. They are different when they are mandatory just to cover rent. A second job can increase income, but it also consumes sleep, parenting time, study time, and health. The sign is when extra income is no longer extra. It becomes part of the survival structure. If losing the side hustle would make rent impossible, the main paycheck is not enough. Gig income also has a catch many people learn late. It can be irregular, and taxes may not be withheld the same way wages are. The app may show earnings, but the real profit depends on fuel, mileage, supplies, unpaid time, and wear on equipment. A side hustle can help, but it can also turn the worker into a tiny business with no benefits and very little cushion. The 15th sign is that people stop dreaming in years and start surviving in pay periods. This may be the deepest sign because it changes how people think. A financially stable person can plan in seasons. A vacation next year, a home repair in the fall, a move in 2 years, retirement decades away. A paycheck-to-paycheck person often plans in days. Rent Friday, gas Monday, groceries after payday, minimum payment before the late fee, doctor later, savings someday. This shortens the future. It can make people look impulsive when they are actually exhausted. It can also make small pleasures feel urgent because the future already feels stolen. That is why finger-wagging advice often fails. It ignores the psychology of scarcity. When the brain is always tracking shortages, it has less energy for long-term planning. The person is not broken. The bandwidth is overloaded. The final sign is not only an empty account. It is a life where every decision is filtered through the next paycheck. This is why many people sound tired, even when they are not asking for sympathy. They are carrying a mental spreadsheet all day. They know which bill can wait, which one cannot, which card has room, which store has cheaper eggs, which road saves gas, and which invitation must be declined without explaining why. That invisible calculation is part of the cost. So what does all of this mean? It means the 78% headline is powerful, but the real story is more detailed. The strongest reading is that a huge share of workers would struggle if pay arrived even 1 week late. That fits with other warning lights. Record renter cost burdens, stubborn grocery pressure, millions facing food insecurity, more than a third of adults unable to cover a modest emergency with cash or its equivalent. High household debt, rising pressure from insurance, fees, transportation, and subscriptions, and wages that do not always beat prices after inflation. The signs are not about one bad habit. They are about a system where basic life has become expensive, timing has become brutal, and millions of working people have little margin for error. The biggest takeaway is simple. Paycheck-to-paycheck living is not always visible. It can wear a uniform, drive to work, pay taxes, raise children, and still be one delay from panic. Another takeaway is that personal choices matter, but they are not the whole story. Budgeting can help, cutting waste can help, debt planning can help, but no spreadsheet can fully solve rent that is too high, wages that lag costs, or emergencies that arrive faster than savings. And the final takeaway is that shame is useless. Clarity is useful. If these signs sound familiar, the first step is not pretending everything is fine. It is naming the pressure, finding the leaks, protecting cash flow, and refusing to let small traps turn into permanent traps. There is also a dignity issue here. A person can make imperfect choices and still deserve a fair chance to breathe. But honesty matters too. Some households are being crushed by prices, some are being hurt by debt decisions, some are being drained by habits they have not audited in years. Most are dealing with a mix of all three. That is why the answer cannot be only blame the system or only blame the individual. The useful question is sharper. What part of the pressure is structural? What part is controllable, and what part needs help from family, community, policy, or a serious reset? When people ask that question, they stop arguing over slogans and start seeing the machinery. They see the rent before the groceries, the insurance before the savings, the interest before the progress, and the fees before the breathing room. That is the real value of these signs. They turn a vague feeling of struggle into a map. A map does not fix the road, but it shows where traps are hiding and where the next safer step begins. If this video made you think differently about what broke really looks like in America, hit like so more people see it. Comment with this question: which sign do you think is the most ignored? Rent, groceries, debt, or the one-week paycheck delay? And share this with someone who thinks working full-time automatically means people are doing fine, because millions of Americans know the truth is not that simple.